Hey everyone, have you ever scrolled past a news story about some giant company and just wondered, how in the world do you even begin to put a price tag on that whole operation? Well, today, we're going to demystify one of the most famous tools investors use to do exactly that. I mean, it seems impossibly complicated, right? You've got factories, patents, thousands of employees. But what if I told you that more often than not, Wall Street starts with a favorite shortcut, a single number they look to first to get a read on a company?
And yup, that shortcut is the price-to-earnings ratio. You've probably seen it called the P/E ratio. It's everywhere. But what is it actually telling us? Let's break it down.
Okay, so at its core, it's pretty simple. You take the company's stock price and divide it by its annual earnings per share. So if a stock has a PE of, say, 20, that literally means investors are willing to pay $20 for every $1 of profit the company makes. It's like a quick snapshot of the market's mood or its expectations for that company.
But right away, we hit our first little wrinkle. Are we looking at the earnings the company already made or the earnings it's expected to make? See, a trailing PE uses the real hard numbers from the past 12 months. A forward PE, on the other hand, is a forecast, an educated guess. And since investing is all about the future, most analysts really zero in on that forward PE.
So this brings us to the million-dollar question. What makes a PE ratio good? Let's try to unlock the code behind this number.
Right? This is what everyone wants to know. Is a low number like 10 an automatic bargain? Is a high number like 30 a total ripoff? Well, the answer, it's not quite that simple.
You see, a good PE isn't some fixed number. It's all relative. A PE is only good or bad when you compare it to what the company actually deserves, based on its financial health and its growth prospects. Analysts have a name for this. They call it the justified PE.
Okay, whoa, I know this formula looks a little intimidating. Don't worry, you don't need to memorize it, but this is the secret code, the logic analysts use. And it all boils down to just three key ingredients. ROE, which is about profitability, G, which is all about growth, and COE, which is about risk. Let's quickly look at each one. First up is ROE, or return on equity. You can think of this as a company's report card for how well it makes money using the cash shareholders gave it. The higher the ROE, the more profitable the business is. It's the engine. Next, we've got G for growth. This one's pretty straightforward. It's how fast the company's profits are expected to grow. It makes sense, right? A company that's growing like a weed can justify a much higher price tag today because everyone wants a piece of that future success.
And finally, there's COE, the cost of equity. This is basically the market's price for risk. If a stock is seen as a risky bet, investors are going to demand a higher potential return for taking that gamble. And here's the crucial part. Higher risk actually lowers the PE ratio a company deserves.
Now check this out. This is where it all comes together and gets really interesting. Look at how these numbers play off each other. If you have a super profitable company, that's a 30% ROE, and it's also got strong growth, 10%, look what happens. It justifies a PE of 100. This shows you so clearly that for really high-quality businesses, even a small bump in expected growth can cause its fair value to just explode higher.
So here's the bottom line. You figure out the PE the company should have, that's the justified PE, and you compare it to the PE the market is actually giving it right now. If the justified number is higher, you might have just found yourself a bargain. If it's lower, the stock might be overpriced.
All right, so you've got the secret code, you understand the logic, but now we got to talk about the tricky parts, the common traps where the PE ratio can seriously mislead you. The absolute biggest mistake people make is comparing apples to oranges. You just can't compare the PE of a slow and steady consumer goods company to, say, a high-risk, high-reward biotech firm. Their profitability, their growth, their risk, it's all completely different. You have to compare PE ratios within the same industry. Now let's talk about a special kind of tricky stock, cyclicals. These are companies in industries like cars or airlines that do great when the economy is booming and terrible when it's not. The legendary investor Peter Lynch had a great warning about them. It's like a game of blackjack. Timing is everything. And this leads to a wild paradox. For these cyclical stocks, the PE ratio is often at its absolute lowest when things are going great and profits are at their peak. It looks cheap, but that super low PE is often a massive warning sign that the good times are about to end and profits are about to fall off a cliff.
And you know, sometimes the PE ratio just isn't the right tool for the job. For companies that have a mountain of debt or for capital-intensive businesses like telcos, analysts often turn to a close relative of the PE called EV to EBITDA. It's a bit more complex, but it gives you a much better picture of the total company value, debt and all.
And this whole idea of using the right tool for the right job brings us to an even bigger concept, a company's life cycle. Because how you value a company really depends on where it is in its own life story.
You can basically break down a company's life into 4 main stages. You've got the startup phase, the exciting growth phase, the steady mature phase, and then eventually the decline. Think about it. In those early startup days, there aren't any earnings, so the E in PE is 0, or even negative, making the ratio totally useless. At that stage, valuation is all about judging future potential. It's only once the company starts growing and actually making a profit that the PE ratio finally becomes a useful tool.
Then, for those big, mature, stable companies, the focus shifts to predictable cash flow and dividends. And for companies that are in decline, it shifts again, this time to what the company's assets are worth if you just sold everything off. The tool has to match the stage of life.
So, after all of this, the formulas, the traps, the life cycles, what's the big takeaway? Well, it really comes down to a simple choice in how you look at that number.
Because a PE ratio is never really just a number. It's a story. It's a condensed story about that company's profitability, its prospects for growth, and the risks it's facing along the way. And the cool thing is, now you know how to start reading that story. Thanks for tuning in.